Welcome to the CFO Track podcast. I'm your host, Tom Hunter, and every week I'll be bringing you stories from some of Australia's best and brightest CFOs and the lessons they learnt along the way. My goal for the podcast is to provide learning and development opportunities for those wanting to get to the level of the guests on this show, but they just didn't have the access to those lessons otherwise. Let's get into it. On today's show, I'm speaking with Sean O'Donoghue. Sean recently finished up as the CFO for leading payments and banking business, Cuscal. Sean has a wealth of stories, including the restructure with Multiplex following the $500 million loss during the construction of Wembley Stadium. He also gives fantastic advice on how to run a successful IPO after the great result with Cuscal. His approach to innovation and building value is one you don't want to miss. I hope you enjoy it, so here we go. This episode is brought to you by Tallystone.com, the all-in-one data room, capital register and board workflow in one continuous system of record. Check out the detail mid-episode. Sean O'Donoghue, welcome to the CFO Track podcast.
Tom, thank you very much for having me. I really appreciate it.
Absolutely. Nice to be here. How's the week been?
It's been pretty busy. Just a few things sort of going on, bits and pieces here and there. So you got to try and keep your eye in somehow. So that's what I've been trying to do.
Yeah, nice side. It never really stops, does it?
No, it doesn't stop. Every time you think you're done, it's like that. I think it was The Godfather. Every time you think you're out, they pull you back in.
Pull you back in. Perfect. Well, I've given the listeners already a bit of an intro to yourself, but I can never do it justice. It'd be good to hear it from you. A bit of an overview of where you're at the minute, what sort of stuff you're doing.
Yeah, okay. Yeah, I've sort of recently retired from full-time executive CFO corporate life just before Christmas. I thought I might embark on a new phase in my career, away from the day-to-day executive roles into looking for more, sort of non-exec director type roles, interim CFO, that type of thing. It's something a little more flexible than the day-to-day role. So I was about 12 years at Cuscal, which I used to say to my boss, it seems a lot longer. But that's a fair amount of time anyway. So prior to that, I was at a host of different companies, particularly in the property sector, through sort of Lend-Lease back in the early days, Abacus Property Group, Multiplex. And then I sort of went into a bit more of the financial services side of things, Commonwealth Bank, Westpac, and then ultimately back to Cuscal. And as I say, I was there about 12 years, and we took the company through a number of strategic sort of pivot points and ultimately listed on the stock exchange in November 2024, which was an interesting time for a lot of people, including me.
Absolutely. Well, we'll come back to that, but it sounds super interesting. But it'd be good to get a feel for where it all started, because the whole idea is to give up-and-coming accounting and finance professionals a bit more scope about how they got to that point. So what was it about finance? What was it about accounting that drew you to the industry?
Yeah, so I guess I was sort of advised by my father at the time, to be honest. And have a look at me, I'm 120, so so I've been around the block a few times. So my sort of parents were always in business. And business was, it was something that I've sort of grown up with. And I remember at the time thinking about what direction should I go in? And the advice I got was, if you're interested in business, it's fundamental that you understand the balance sheet, the P&L and the financials of any business. And the best way to do that for me at the time was think I'll become a bean counter and see where that takes me. My original intention, I always wanted to be a rock and roll singer, but sadly have absolutely no musical talent. So I end up being
there's a few out there that don't.
So I end up being an accountant. So there you go. It's an obvious transition. But that was really what drove me into, I guess, the financial sort of side of things. Was really being in a position to understand the numbers. If you're interested in business, at the end of the day, I know it's about different stakeholder groups and various things, but at the end of the day, it always comes back down to the numbers. and being able to understand and advise people around those numbers, I think was pretty important, and I think it's held me in reasonably good stead over many years.
No, so you went to uni. I think you went to KPMG or something at the
Yes,
time.
that's right. Yeah, so I came straight out of school and did what was called a matriculant program with KPMG, which was actually Pete Marwick Mitchell back in those days. So that's how long I've been around, and it's been through a number of iterations, and obviously ended up at KPMG. I started in an area called private business services. Not in audit per se, and I particularly chose that area for purposefully to get a broader understanding of the fundamentals, the nuts and bolts, if you like, of accounting, and we did pretty much everything from shoebox receipts right through to audits and tax work, corporate advisory, and obviously, this is back in the sort of early '80s into mid '80s when superannuation was just starting to get some legs, prior to the guarantees, etc. So it was a broad gambit of experience sets that I got, and I think that's held me in fairly good stead over a long period of time.
So when did Excel come in? Because that was around then,
so
right?
I was there. I tell anyone who'll listen, I was there when Microsoft Excel was invented in, I think it was 1983. And we used to use Lotus 1-2-3. I don't know if you young guys even remember that.
I didn't use
that. And so Excel was invented, and I was over the moon because it was, you actually used an equal sign in your equation, not an ampersand. And I went, oh, how good is this? So it's taken off from there.
Did it change much at the time? Like, is it the same where people are thinking and going nuts with AI and go, oh, it's going to change everything? When they were bringing in Excel, were people losing their minds?
I think it did. It was a bit of a revolution. Certainly, if you think about what we were doing at the time, and again, this was very early in my career, but my first job was to close off the ledger using the red journal book, to put a journal in, manually write a journal in, and then transpose that into the ledger. And you literally got your ruler and you ruled it off, and you brought things forward and carried things forward. And you similarly with the old green cash books, which the Excel spreadsheet basically replaced. So you can imagine it was quite revolutionary in terms of productivity, that you're no longer having to manually do those things. It's akin, I think, to what AI is doing for us now. Obviously, the horsepower is a lot better, and and it's a little bit.
Was there a lot of chat and I guess fear around job losses and all that kind of thing at the
time?
No,
I don't know. I don't think there was. I think it was for us a tool that was going to enhance productivity and free us up from that more mundane sort of pieces of work to be able to concentrate, get through the routine quicker, but then be able to I guess turn your attention to more advisory.
Sounds familiar, right?
Yeah, it's really no different, I don't think. And sort of AI's, the pace of change. If you look at what happened in the '80s, even with the personal computer, and your ability, and the ledger systems and those sorts of things. I remember Solution 1, 2, 3, and Solution 6, and the Apple Mac, and all those things coming in. And I remember as a young bloke having to carry around the Apple Mac on my shoulder, and a dot matrix printer. So you kind of sit back and you go, oh, well, I think the world's moved on a fair bit since then. But it really was about productivity increases and being able to, particularly for a finance person, focus less on that day-to-day routine stuff, and being able to sort of turn your attention to what you've been trained for, was to really be advising the business as to what they should be doing, looking through, I guess, the what to the what next, to what are we going to do about this. And I think that's where AI can really help these days. I don't see it myself as a job loss scenario. I think it's something that just adds to people's productivity over time.
Yeah. We'll come back to it in a bit. But so did you spend some time in Hollywood while you were at KPMG?
Yes, I did. So I went over to, I worked in Los Angeles for a period of time, went over and did my MBA at a uni called Pepperdine University in Los Angeles. And so while I worked full-time and did uni.
Mm.
I did the full-time load, but did it part-time
Yep.
at night. You can
Sure.
imagine American universities don't come for free.
Sure.
So I sort of did that. So I worked in KPMG Century City office back in 89 to about 91, 92. In
Right.
the
Okay.
actually, and their focus was obviously, as you can imagine, the motion picture industry, or
Yeah.
entertainment. It
Yeah.
was an entertainment practice.
Sure.
So I spent a lot of time with in Hollywood, either at
Yeah.
film companies or at
Yeah.
radio stations, etc., buying and selling
Yeah.
radio stations. That's I did a little bit of audit work over there, but
Yeah.
auditing a lot of film companies, which was very
Yeah.
interesting. When you
Yeah.
know
Yeah.
that's not something that's sort of mainstream here, but certainly in
Sure.
the US, there's a very specific accounting standard around accounting
Yep.
for motion pictures,
Right.
which was, I
Okay.
don't know if it's changed. It was called FASB 53, very prescriptive.
Yeah.
It
Yeah.
was
Yeah.
like a book, and you'd go through that, and you'd use that to audit your film companies, which was, it was a very interesting time. Some of the stories I can remember from those days about how deals were done and or not done,
Yep.
and amendments
Yep.
coming out of drawers, and certainly at
Yeah.
the end of the day, a lot of deals just got done over lunch. And there was, if
Yeah.
you're the auditor of the company, you always like to see some documentation. Sometimes you were
Yeah.
left with, oh, no, I just spoke to Joe and we just did that deal over lunch. So,
Yeah.
you go work it out.
Yeah. So, at what point did you decide to come home?
I finished my degree. I spent another
Yep.
year or so there. I guess I was sort of newly married at the time, so we'd sort of
Okay.
gone over,
Sure.
and I'd always said I was only going for a 2 or 3 years maximum. The purpose was to go to
Sure.
uni over there. Did that, and it was always going to come back, and it was just that was the plan, and that's what we did. So back we came, and I signed up with Lendlease through MLC. Was my first
Yeah.
sort of
Right.
job back in those days. But it was 1991, which
Okay.
was interesting, into the funds manager, the fledgling funds management industry, unit
Right.
trust industry of Australia. And at the time, there was ourselves, I think Colonial, First State, as they became, and BT
Mm.
were
Okay.
the three kind of big, I guess, leaders in the unit trust industry, in the mutual sector, mutual
Yep.
fund sector.
Right.
So I kind of started in there as a trust accountant, and
Yeah.
sort of
Okay.
gradually made my way through to chief financial officer of what was MLC Investments back in those days, which
Right.
was the
Okay.
retail unit trust business of Lendlease,
Yep.
of MLC. And that sort of iterated over time into, we sort of folded the single premium products. We realized the single premium products in the life company were very similar in nature to the unit trust business. So we sort of built a new platform, a pricing platform, that we could, I guess, price all the investment side of the business, and homogenize that. Um, and then we did a big cost program. I remember we did a process redesign program back in about 95. And we took about
Right.
40% of the unit cost, the fixed cost, out of MLC. You think about a 140-year-old life company. There was a little bit of largesse floating around. So, but we did that.
Sure.
Everyone got on board. That was led very much by the chief executive of MLC at the
Yeah.
time. So there was nowhere to hide.
Yeah.
Everyone was committed to it, and I think we achieved that. And that wasn't something that was, just cut your costs tomorrow and be done. There was a 3-year program, looking
Mm.
for, which I think is important in a lot of these programs. You've got to give people enough time to genuinely change the underlying process that they're working with.
Yep.
Um,
Yep.
Otherwise, all you're doing is, you cut your costs type of thing. All you're doing is loading up the people that are still there with double the work,
Sure.
and that's never a
No.
sustainable outcome. So I think that was a really important lesson, and certainly in my career, as to when you're
Mm.
looking at productivity, you're looking at efficiency. How do you make it sustainable? It's very
Mm.
easy to kind of go, well, this half of the room, services are no longer required. As I
Sure.
say, all you're doing is leaving the other half with double the workload, and
Yeah.
not so great process. So you've got to really
Right.
address the process side of things if you want to get sustainable outcome. Now, whether that's genuine manual process, automated, or you start to use broader technology skills and broader emerging technology platforms like AI into those processes, sort of cut the repetitive nature out of them. And that, as I say, that was a lesson I learned very early, I think, in my career as a reasonable young bloke back in those days.
Sure.
And that sort of stayed with me as a philosophy over the course of my career.
And so that was your first CFO role at that time?
Yeah, that was my...
So what did you take from that? What was it like? What was the imposter syndrome like? All that kind of thing?
Yeah, it was interesting. It was interesting to go from, I guess, a functional role into a broader role. I had gone from a trust accountant, very focused. In fact, I was focused on the international funds. That was my gig. To the broad manager of trust accounting, which is glorious term, now very high profile term, to the CFO, and it was combining. You've still got responsibility for your unit trust and your investors on the investor side, but you've also then got the dual responsibility of your shareholders and the broader, I guess, stakeholder group that a CFO really needs to take care of. So that was a little bit of an adjustment, but I don't think it was a great adjustment for me, because I guess I'd always sort of been on both sides of the ledger anyway. But certainly it's just the breadth of stakeholder groups that you need to be cognizant of, I think was probably the major learning for me at that point in time.
Anything else that came along with that was unexpected that you didn't anticipate?
Not really. I guess one of the key lessons, very early lessons I learned, and this is, I think, important for young people sort of coming through the ranks, is really around being on top. You've got to be on top of your numbers. Particularly Lendlease at the time had a reputation of being very much on top of its numbers. So there was a very high expectation that any CFO in the group knew exactly what was coming, and had plans if scenario A, B, or C didn't come off. So you were always expected to have, I guess, a plan B or plan C to meet the numbers that you committed to. So one of the things that's really important, as I say, is being really on top of in the detail of your numbers, enough to know intuitively which way they were going to go. What are the key drivers of your business? And I tend to think, a lot of people go, oh, it's too hard. I think there's only ever a handful of really fundamental drivers of your numbers, whether that's your P&L or your balance sheet, which I think is quite important as well. But being on top of that and having a really rigorous forecast process that you're constantly updating and rolling. So at any point in time, you can kind of get visibility of what might be coming and what are your upsides and downsides against your base forecast. I think that was a lesson that we very much, certainly the Lendlease group, very much put in place at the time. So not only what's your forecast going to be, but what are your scenarios? How do you mitigate those identify and mitigate the downsides? Identify how do you realize the upsides? And invariably, there's a combination of both of those ups and downs that happen over time. So how do you respond to one or the other? And how do you manage your profitability when you've got uncertainty and different scenarios facing you at most points in time? So I think that was probably the most fundamental lesson that I learned back in those early days, and have carried with me right through all the various iterations of roles that I've had over what seems like a long period of time.
And so when you say know your numbers, is that being hands-on yourself, or are you saying to get the team, making sure that they're across everything and everything they're coming to you and really entrusting them? Like, where's that balance?
Yeah, it's a combination of the two. It can be a bit of a double-edged sword as a CFO, because some people intuitively want to be right into the detail, and therefore know from the ground up where things are going. There's got to be a balance there, because, as I say, if you've got an extended stakeholder group, you don't have the luxury of burying yourself in numbers and really getting getting a really good feel for it. So it comes back down to the capability of the people that you have working with you, and good capable people. You trust them, and you'll trust that they've got a similar philosophy, that Mary Beth or Joe or whatever is really into that detail, and when they give you an answer, you can trust it. I think that's really important. But like you say, you can't. Another lesson: you can't do it all yourself. It gets too hard. You just don't have the capacity yourself to do it. You've got to get capable people who understand it, who high attention to detail, understand intuitively how your drivers are working, and then you can build the trust of your teams as you go forward, regardless of how big your organisation gets.
I know that to close a capital round, everything has to be spot on, but we've had our moments where we've had to scramble. The cap table is in a spreadsheet that might be right, the board resolutions are in a Dropbox that nobody's paying for, and an email thread from 2022. And the data room, that was built on a Sunday night because the investor asked for it by Monday. We know better, and we know how risky it is. Tallystone puts all this in one place. AI-powered data rooms, capital register, board and shareholder workflows. One system that's always current, not just when an investor asks. I use it for story recruitment, and it works like a dream to get set up. So make your job easier and de-risk the DD. It's the infrastructure that your corporate record should have had from day one. Start a free 30-day trial and get a live data room set up in 10 minutes. Use the promo code CFOTrack and find out more at tallystone.com. Let's get back to the show.
And then then following that, you'd spend some time with Abacus at the same, just after then? Right?
Yes. So I had a bit of time. I actually went overseas. I came out of MLC into Lendlease. I spent out of MLC. We went down and started up. This was a time back in the late 90s when superannuation member choice was just coming in. So MLC partnered in a JV with Vanguard, who was one of the world's biggest fund managers. They've got trillions in assets. So we partnered with them to start up a superannuation member choice company, and that was literally from scratch. The four of us walked into some vacant space in Collins Street in Melbourne and went, this looks good. Yeah, let's start a company. Fortunately, we had some pretty good backing, some pretty good shareholder backing to do it. So we weren't taking very much risk ourselves. But it was literal startup, as I say, from premises right through to building the systems, the superannuation admin systems that were going to cater for multiple superannuation fund choices from members. That's obviously emerged as a strong point in the super industry over the years. At the same time, we built our own investment platforms, unit trust platforms, which, good news, I'd just done that spent 8 years at MLC managing those, so that wasn't something that I needed to learn very quickly. But again, you're sort of building the technology, and at each iteration, you sort of start to try and think, what's the latest tech stack? What's the latest technology that's going to be sustainable in a few years' time? In 3 to 4 years' time versus what's the latest today. So I think that's another important lesson from the Plum days. So it was Plum Financial Services. When you're building technology, it's not about what's available so much today. It's about what do you think's going to be, and how do you provision for things that you look at the pace of change of technology. And if you're building today, you can almost guarantee in 2 years' time it's going to be semi-redundant. Or latent. So how do you kind of build your scale in? How do you build the technology stack such that it's scalable as your organizations grow? And that was another really important lesson I sort of took out of Plum. And I think we did that, both on the investment side and on the member administration side. So we did that for a couple of years and then went back up into Lendlease Corporation, into the head office, and was the group management accountant for Lendlease at one point in time. I did that for about a year or two, about 2 years, and then I ended up in Atlanta, Georgia, where we had bought Lendlease Global Real Estate Investments, had bought a series of companies in the US, that were the main one from the Equitable Group that was based in Atlanta. So I became the global GM of finance of global real estate investments, and ended up in Atlanta for a couple of years. It's about 3 years over there. My two oldest kids started went to school over there for a couple of years in primary, which was interesting. Most of the time, they ended up taking on American accents because the kids couldn't understand. They put on an American accent because the kids couldn't understand the Australian accent. So that was very interesting. So we did that, and then sort of we sold the global real estate investment business of Lendlease. So sort of I came back to Australia, a little bit of time back in head office for a little bit, and then I thought, that was about 12, 13 years that I'd sort of been with the Lendlease group, and I like to kind of keep moving, and next different phases of my career. So I sort of left there. Left Lendlease at the time. I thought if I don't go now, I probably never will. So I thought I'll go and try something different. Went to Commonwealth Bank, which was interesting and really good. A lot of sort of older alumni of Lendlease and MLC had kind of migrated there, so it was a bit like the old home week in some respects around CBA. So I did that for about a year or so, but then I got an opportunity to go be the CFO of Abacus Property Group, which was a listed entity, and I thought that, and I really enjoy the property side of things, and I don't not enjoy financial services, but I do find property a little bit more intuitive. So I took the opportunity to go there, and did that for a couple of years, and then I was approached to go to, again, from someone who I knew at MLC back in their very early days, to see if I was interested in coming to Multiplex, who was going through some tough times.
Before the Multiplex move, I think, did you say something you're doing like quadruple staple?
Oh yes, that's I'm going to claim that I'm the only one and still the only one to do a quadruple stapling.
So what is that?
So stapling is where you've got two entities, one both with shares or a unit trust, and it's a construct that I guess by definition staples those two shares together as if they're one. You'll find sort of Westfield did it. They did a triple stapling, but it became quite flavoursome at the time back in the sort of late 90s. Early 2000s to create, because it gives you better control over the return on equity in each of those particular vehicles, because their drivers are different and their motivations are different, but you can pull them together. And then, so Lendlease at the moment, that's a stapled entity. Westfield was a stapled entity. I think you find Dexus and most of those are particularly prevalent in the property sector, because you want to put your assets into a trust because you get a better yield, and it's a better cash flow yield out of that versus your operating business in a company. So Multiplex was the same when I went there, but I wasn't satisfied with stapling two companies or three, so I thought I might do four. And as I say, I still claim I'm the only one that's ever done a quadruple. So.
Is there a reason why no one's ever done it?
Not really, only because they probably never had four companies that they wanted to put together. They weren't. We had an unlisted fund, which was itself a staple, and we had the listed entity, which was a staple. So we unwound the unlisted fund and stapled both the operating business to the operating business and the investment trust to the investment trust. So that it was more structural than anything else. So. It wasn't any more revolutionary than that. That was what was in front of us, so that's what we did.
It sounds complex. Is it as complex as it sounds?
I didn't think so. I didn't think so. But the complexity always is in the preparation of your documents for it. You're basically doing a prospectus or an information memorandum, and every time you want to move the beneficial ownership of stock around. Obviously you've got to do the right things by your investors and give them the right information, enough information for them to make informed decisions. That was probably more the impost is more around the documentation and giving people enough info that they can make the right investment decision, which is always fundamental. I think regardless of the nature of the security, I think that that's something that really needs to be made sure is proper and veracious.
And so you're saying a couple of years later you'd moved on to Multiplex?
Yeah, so I did Abacus for a few years, and then went down to Multiplex. And they were going through a few issues at the time. We were just on the back end of finishing Wembley Stadium, so Multiplex built Wembley, and they had a few hiccups along the way. I remember the steel contractor went broke, which is not good when you're trying to build a steel structured stadium. So there was a comedy of, I guess, a domino effect that really sort of hit the company. But I always say to Multiplex's credit, it finished the job. It could have kind of probably walked away and went, this is too hard. But I think reputationally it did the right thing, and the management did the right thing at the time and completed it. It cost a lot of money. It lost a lot of money. But
what was the figures in the end?
Sorry,
if you can share. What was the loss in the end?
I'm gonna say north of $500 million, I think.
Yeah, right. Wow. Okay.
Yeah, so we had to do some structuring across the staple at Multiplex. I remember doing that just to make sure that both sides of the entity were solvent. So we did that, and we, as I said, we got through that. I think reasonably well under the circumstances, and it was a tough time for a lot of people. Different groups coming at you about this, that, and the other, and as I say, I look back. It was a tough time, but I look back really fondly on and a lot of the learnings and a lot of the sort of the risk processes that you kind of go, okay, well, maybe we should have done this or should have done that. And I find every job you have, you always want to take something that you learnt from that last job and apply it to the next one, and there'll be new learnings in the next role. But always keep a ballywick of things that you learnt from the last one. So I always say I might get stung, but I'll only ever get stung once for the same thing. So I might get stung a few times, but at least they're for different things, not for the same thing over and over and over again.
So those dominoes that you're saying, do they happen in quick succession, or is it like an incremental thing over time and like, oh shit, that's gone wrong, and then that's gone wrong, and before you know it, you're $500 million under and all the rest?
It's a sort of this sort of process, and this happens a lot, and where you just respond to a circumstance at the time, and you make that response, and then sometimes it can go in quick succession. Sometimes it can be incremental, and you're responding to the next threat or the next risk. And sometimes it feels like, when are you going to get a break, because it just keeps piling. Ultimately, generally, my experience, you do get a break if you really sit back and don't react but respond. I think is an important way to look at it. If you just respond, or if you just react, you're going to find yourself at the behest of the next trauma that's going to come at you. If you respond, it's much more. It's subtly in the language, but it's more considered response, and you do it for a purpose. And then you look at the next piece of information that you got. You might make a different decision, but at least you're making it on a sound basis, a data-driven basis, not, oh my God, look, the world's falling in on me. I don't react to things. I sit back, analyze, make a decision, and that decision might not be right. As in hindsight's always 20/20, but at least it was purposeful. And I think that's an important lesson for a lot of people as well, to think about how you respond to something, not just react. Because if you react, oftentimes you'll fall into a trap the next time around, or something will befall you very quickly.
Yeah. So at the time then, what was the response? Like, how do you overcome a dramatic event like that?
Well, I said I guess you knuckle back down. You look at back at your fundamentals. Okay, where's my cash
Right.
flow? What's my what's my forward workload? What's my cash flow? What can I cut back? What can I kind of defer, eliminate, stop? For
Sure.
periods of time. So you start to make those decisions, and that's
Yeah.
not exclusive to a property company or any. That's just generally how business kind of works. It's you've
Right.
got to start making prioritization decisions across your business. And if
Yep.
the shiny new toy here, you may not be able to do that just yet.
Yeah. Yeah.
It's not dead
Yep.
in the water, but you might want to focus more on this for a period of time, settle that down, and then go on to it. A lot of times, I think a lot of people want to do everything, and different interest groups, go, yeah, I hear what you're saying, but I'm different, and I'm
Yeah. Yeah.
special. You go, well,
Yeah.
For a finance guy, I don't find anyone different or special as it comes
Sure.
down to the numbers of your company. Everyone's got to kind of have a look at the situation and understand that prioritization decisions need to be made, and you do those in an orderly fashion. You never like to kill anything. If it's a good idea, is a good idea. It's just I always think it's only ever a question of timing. It's not a question. I mean, if it's a silly idea, clearly everyone goes, I'm not going to do that. But generally speaking, I haven't ever found management teams that are stupid and putting up dumb ideas. They're always good ideas. From my experience, it's the question of when do you get to do it, and where's your priority, where's your capital flowing to, and what's the priority at a point in time. You can always circle back on good ideas later on, and they become more urgent. Then you might deprioritize something that yesterday you thought was a priority. But again, you're making affirmative decisions and data-driven decisions, not, well, I don't know what I'm doing, and I'll just every child gets a prize. That doesn't kind of work that well in business. I don't find.
And so there's a couple of roles with Westpac and BT, but at what point did you get to Cuscal?
So I did a couple of roles in BT. So I joined. We sold Multiplex to Brookfield. And then I sort of left there and went to Westpac and did a variety of roles, and quite purposefully did a couple of roles that were non-traditional finance roles. So I did some more sort of finance transformation stuff, and the integration of BT Financial Services and St. George Private Bank. Pulled that together, did the finance transformation, acquisition, integration, kind of transformation stages of that. Did that for a couple of years, and then went back up to Westpac Group and ran the enterprise portfolio management office, the EPMO, up there, which was again, I'd say non kind of financial, although I do find having spent nearly 20 years in project management based companies. I think that the discipline of project management and the skill set is equally applicable in general management. I don't think it's exclusive. It's mutually exclusive to to construction companies and those sorts of things. So I did that for a couple of years, and then thought, okay. Then I was offered an opportunity to go to Cuscal, and I liked its positioning at the time, and I thought it had some really good growth prospects in terms of where we wanted to take the business. So I went there, and
so was that back into a pure CFO style role, like your traditional style, or was it still a project management style?
No, it was more into your, I guess, more traditional CFO role. So I kind of laughingly say it was time for me to get back on the calculators, away from not pressing buttons all the time, back on the calculators. So we did that. It was so at the time we were. This is going back into the 2012, 2013s.
Okay.
Cuscal was I would have said more like the wholesale bank to the credit union. So Cuscal's sort of heritage is in the credit union movement as an aggregator of deposits and a securitizer. So we did a couple of securitization trusts and those sorts of things. But back in those days, we made a couple of strategic kind of decisions. First was to insource. Was supposed to become a purer payment company and focus more on payments. And there were really three, we sort of articulated three key, what I call enduring themes. Which seem, pretty self-evident now, but if you think about this back in 2013, 2012, it's really around digital mobile, real-time payments, and data. They were the three kind of enduring pillars of strategic pillars, we sort of called them. So everything we did from there was referenced back to those three strategic pillars. The first, one of the key things we did was insource the what's called a payment switch, which had previously been outsourced. It's the technology that moves money, as it says, switches. If you're one of our customers and you're with CBA, then our switch will move more money into and out of those accounts, etc. So we insourced that. That was a major strategic play to take control of the destiny as a payment company. Otherwise, you're beholden to an outsourced provider. That was really important. So we did that. That was key. We also sort of looked at, I guess, this balance sheet, the wholesale, the banking business, and kind of decided we might probably better for us to exit that business and focus more on those three digital real-time and data-driven strategic themes. So we exited the banking business. So where Cuscal is a bank, it has a banking license, so it can take deposits, etc. But we then use that banking license more as a risk management tool. So our customers got a little bit more. A lot of them were banks themselves, so they got a lot, quite a bit more au fait with and comfortable with us and our processes and being APRA regulated than you would perhaps somebody else who wasn't sort of APRA regulated, and it kind of goes right through. So that was we saw that as very much a strategic advantage, a competitive advantage. It does kind of drain your return on equity a little bit because you've got to keep regulatory capital, which can be a bit constraining, as opposed to a pure payment processor who doesn't have regulatory capital. So their return on equity would generally be a lot higher than ours. So there's always a balancing act, which we understood and tried to articulate to our clients. But they, as I say, we saw it more as a competitive advantage and a safe haven for people to transact in than an unregulated entity, which there's nothing wrong with those. I mean, they do a good job. This is just a little more of a risk management tool for us. So we sort of exited the banking business, focused more on the payment business. We're a founding member and shareholder and builder of the real-time payment platform, which launched the first phase, launched in 2018. Cuscal, I think, I'm pretty sure we were the first transaction ever on the real-time payment platform in 2018 on the phase one. And I think we did phase two, the first transaction as well, the pool payments on phase two in 2022. So we always in the payment space wanted to be at the forefront of innovation and be there as quick as we can for our customers. And then we did.
Quick one before we get back to it. If you're listening to this podcast, you probably already know that I recruit for senior finance professionals for high growth businesses. That's what I do outside of this show. My approach is built around storytelling. When I take on a search, I build a narrative around the business, who they are, what they're building, where they're going, and why that role matters. Before I reach out to a single candidate, I tell that story across multiple channels to my network of over 28,000 finance professionals in Australia, so that when I do start conversations, candidates already know who you are and there's a level of buy-in before I even contact them. So if you're a founder, CEO, or CFO that's thinking about a finance hire, even if it's early days, I'm always happy to chat. Whether that's a question, some free advice, or a sense check on what the market looks like. You can find me on LinkedIn or at storyrecruitment.com.au. All right, let's get back into it.
Sorry, is that when 86-400 started coming
Yeah,
into the
no, so we
market?
looked at 86-400 back in about 2018. So 86-400
Yeah, okay. All right.
was a digital bank, and it kind of did come off the back of real-time payments and our capability in
Okay.
real-time payments. And again, I come back to this notion of strategic theme around digital mobile. And what we wanted,
Right.
what we felt that we could demonstrate the capability of in the digital banking space. As a digital bank, payments are critical because it's the customer experience that people get. Typically, it's how they transact in a digital sense. So we felt at the time that we wanted to demonstrate the payment capabilities of what could be done in banking versus the old world of BPay and blah 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 blah, using real time payments as a mechanism to underwrite your transactions in a digital bank. So that was the kind of strategic driver. It wasn't ever for us to own a retail bank and have access to retail customers. It was only we were always going to dilute out. It was more about demonstrating capability in mobile digital and real time, and ultimately data, which was, as I say, were the three strategic themes that we had. So we initiated, we seeded, we licensed, we capital raised. We went through two series capital raisings, got to Series B. NAB came in on Series B. They were looking at 86-400. They'd started UBank. We think they kind of liked the platform. They liked what we were doing, the modular plug-in and play nature of it in the digital banking world. They then decided that maybe it might be a good opportunity to replatform UBank onto the 86-400 platform. So so they came in and took all of it out. So they bought 100% of the shares in 86-400 post Series B capital raising. So they'd come in with a substantial shareholding in Series B, and then I think decided, hoping this doesn't look too bad, we might want to do this. So I think they've used that 86-400 platform to re-platform their UBank, which was about 4 or 5 times bigger by customer base at that time. And I know a lot of, I'm a UBank customer now from coming from 86-400, and it works really well. It's actually so I like to think we played a hand somewhere in the technology and the customer experience that UBank customers can get. So that was really why we did 86-400. It wasn't ever to compete with, because Cuscal's very much philosophically around not competing with our customers. So so we weren't interested in that B2C type arrangement with the direct customers. So we're B2B business, and we're there to support. We were there to support, I guess, those businesses that want to use us to get more connectivity into Australian payments. So we're the only, I guess, there's 5 companies in Australia that we'd say would have the same end-to-end connectivity into all forms of payments in Australia. That's the 4 major banks and Cuscal. And it's up until sort of November 2024 when we listed, not many people had ever heard of us, which was good in a sense, because you can execute strategic things a little bit easier without every man and their dog telling you how to run your business. Not that that's what's happening now, but that can happen.
And so you're saying that the IPO in the last few years. So what happened for you in the business leading up to that? Like, talk me through the process.
So we kind of realized, if you look at our shareholding base, which was again based in the mutual sector, and we had a couple of I guess approaches from investment banks to us that said, look, we've got this asset. We think you guys are a natural owner of this group of assets. And we said, yeah, we do too. And one in particular we looked at and thought, yeah, that would be really beneficial. We got into the process and were very quickly kicked out of the process as the banks looked to the security of capital and how you're going to fund the acquisition. And for us, we would have to go back to our shareholders because we're regulated. You don't hold excess capital because it'll cruel your return on equity if it's not already constrained. So you try not to hold too much capital. So your play is to go back to your shareholders. You go back to our shareholders at the time were mostly in the mutual sector. Their access to capital is kind of restricted to retained earnings. They don't have the same process to be able to go out into the market quickly with a rights issue or the like and raise capital. So we were thrown out of that process just on the basis of that, notwithstanding we and the bank thought we were the natural owner. So that was kind of a catalyst for us to kind of think, okay, well, maybe it's time to, for want of a better expression, liberate the business from a capital perspective. We asked, so we'd have an opportunity to be able to play and grow and participate in the growth of the payments industry in Australia. So we asked our existing shareholders, put it to them, would they sell down 50%? You can sell 100% if you want into an IPO, but a minimum 50 just to create liquidity and make it worthwhile, and they did. And that's kind of the story behind how Cuscal, in a nutshell, how the rationale and how we got to market was very much our shareholders allowed us to kind of liberate the company in that respect. And we now have access to capital, or they do anyway. I've retired from there. They now have access to capital as any other listed company would have. So they're now in a position to execute the growth agenda without the constraints of capital and raising it in the same sense.
So was it a success then, the IPO, like the immediate 6-12 months?
Well, I think so. I mean, I know they were awarded the Adam Smith IPO of the Year award for 2005, which was pretty good. I think at the end of the day, it's about where your price is, and we listed at $2.50, and it's trading around $4, and so you kind of go, and I know that the analysts have got a pretty positive view on where it's going to go, and the predictability of the earnings. What we felt like the revenue model, the predictability of the earnings, we can feel fairly comfortable in being able to sort of produce a return that's consistent. It's never going to be a hockey stick, but it's always going to be very, very consistent. I used to say to the analyst, it's boring and predictable. Like me, boring and predictable.
What goes into a successful IPO then? Obviously, you don't have hours, but what do you think are the big factors to be such a success?
Yeah, I think the number one factor which we learnt, which we were really, Craig and I were really surprised at when we launched and we did our initial roadshow, and we announced our first sort of period results post prospectus, that we actually met our prospectus forecast. In fact, what I like to say, modestly exceeded, and we did that a couple of times, and we continue to do that. But that was quite astounding to us, because it was sort of like, well, I'm not sure why you'd go to market if you don't have the certainty around. You're asking people to buy your company, invest their money. For us, it was very important that we delivered exactly what we said we were going to deliver. And I think that's a really valuable lesson for companies looking to IPO. If you want it to be successful, you've got to be able to deliver what you said, and you've got to consistently do that, not fly by night. Look at me. So I remember one of the analysts saying to Craig, "Oh, really great result. You exceeded the prospectus." And this was our half year, and I think Craig said, "Well, yeah, it's interesting you say that, because it was only like 6 months ago that we put a prospectus in the market. Had we not been able to exceed it or meet what we told you, I wonder why we went to market." And the response back was, "Yeah, you'd be surprised at how many people don't," and that just blew me away. I couldn't understand how you go to market without being able to deliver what you said you were going to. So that was probably the key lesson for me. And I think that's sort of underwritten Cuscal to some extent, being able to deliver and consistently deliver what you said you were going to do, even outside the forecast period. and keep doing what you sold the business into. I think that's really important.
So I don't know if this is a stitch up or not, but a mutual friend of ours told me to ask you about the spare walls business case.
Yes, this is one of my favorite. I'll give you the abridged version. This is one of my favorites, and to put it in context, if you think about what's really important for people to understand and people to sort of focus on, is what I like to call return on capital employed. Now, whether every dollar you're spending, you either expense it or you invest it, and what's the return you're getting from that? And I always like hard returns, not soft returns that people are smiling more. That's interesting, but that's not really going to make it's not profitable in the short term. So this case we and that's the context of where I was sort of coming from, right? So we refurbed a lab type of thing, and and we had got some TVs into the lab. It was supposed to be like an Apple stand, and it's all campusy and all that sort of stuff. So, so we did that, and the guys put the TVs in, and there was about 4 of them, and then they realised, well, they were a bit small. The TVs they put up, so they pulled them down. They literally left them in reception, and I sort of walked out one day and I went, "Oh, what's the deal with these? Are assets, obviously, right? These are assets of the company. So what's the deal with this?" And someone said, "Oh, yeah, look, they were too small for the." For the lab. So we've got some bigger ones. I said, "Oh, cool. Yeah, okay, that makes sense. All right, fine." I said, "So these are going back and we're, return these and we're getting other ones." And then this person's eyes glazed over and he said, "What do you mean?" I said, "Well, wouldn't you be returning those and just getting the new ones?" He goes, "No, we just got the new ones." And I said, "Well, why are we keeping these?" And he said, "Well, because we've got spare walls." And I said, so that then became the infamous spare walls business case as to how to acquire capital assets because you've got spare walls. And then I said, I wonder what the return on that investment was. It's now gone from an investment to a sunk cost. So that's the spare walls business case. So my point is always think about what return you're getting. How do you minimize the sunk cost on some of your assets that you're employing?
That's good. Yeah. And so you decided to move on from Cuscal. So what does the next few years look like for you?
Yeah, so for me, as I said, I think, as I say, I'm 100. My boss Craig would tell you I'm 100. I'm now 121. I was 120. But look, for me, again, it's looking at where are you at in your career. I guess I felt like I was in a good position post listing of Cuscal. Got through the forecast period, plus another 6. I always had in my mind that maybe it's time to go and do something else and sort of hang up the corporate CFO day-to-day boots and look for a next phase. So for me, I kind of did that just before Christmas. I kind of retired from full-time CFO life. But I'm sort of looking now for what I say, that next phase, sort of non-exec director. I still think, I have something constructive to add. To organisations. So it's that or interim CFO, fractional transaction work. I'm not. I said to some of the recruiting guys, look, I'm retired from corporate CFO life, but not retired from life. So that's what I'm sort of looking to do over the next little while. And hopefully that comes off. But there's no great pressure, to be able to do that. So which is great. It's a great feeling. Yeah.
Nice. No. And so we touched on a little bit before about where AI is going and its place in this space. And you sound like you're a bit of a tech guru. So where do you see it all going over the next couple of years? We won't go 5 years because I think that's too far ahead and things will change dramatically. But where does the next couple of years look like?
So let me just clarify that. If you ask anyone at Cuscal about my tech credentials, they would use the word technologically challenged. In the old days, we might have used a harsher term instead of challenged, but I know we can't do that anymore. It's not the 80s. Look, you look at technology, certainly particularly, I think this is all over, particularly in financial services. You look at the pace of change of technology, each 5-year period, or it's now that period's kind of crunching, I think. and it's still exponential. The next 3-year period is going to be exponential in terms of where technology goes, and AI is a part of that. Absolutely. Rightly or wrongly, I'm pretty cautious about where that technology gets deployed. I remember back in the dot-com boom, of the early late 90s, the internet, and what happened to that? It kind of, things even themselves out over time. The trajectory's always positive, but you can go through spirals. I kind of feel a little bit like AI is the same, but it's gaining a lot more momentum. I do think, like most innovative technologies, I do feel that the ultimate use cases are probably yet to be determined. So you always scratch the surface of, we could use it for X, Y, Z, but I'm not convinced that's the ultimate purpose and the real benefit of AI. I think that's to come, and I don't think we really know yet where that's going to land. So that being the case, you've got to stay in touch with it and be a fast follower. I don't think you need to lead. The big tech companies are all over that, but it's being discerning in terms of how you follow it and how you evolve your own use cases for your own business. I guess my sort of catch cry is very much as an old timer. I'd always say, advice to young people, don't let artificial intelligence replace actual intelligence. And whatever that means to people, I think there's always a role, the nuance of business and the decision-making ability. You can use AI, you can use technology really well. I've never been a subscriber to the computer said so outcome. I think you've always, and I think AI is in the same boat for me. You've always got to look at the output, look at it critically and go, okay, that makes sense, or it doesn't intuitively make sense. So you can't just press the button and go, well, that AI said. I think there's always a place in business because of the nuance and the human nature of interacting with people, etc., which is a very important part of any business, to be able to discern the difference between computer said so, therefore it must be, versus, I'm not sure that actually makes sense. I remember back in, 1982 when, when this happened, So I think that's important. But as I say, I do think AI is mainstream. It's coming. You've got to stay close to it, but be cautious in your application of it just yet, without just relying solely on its output, because I don't think that's the answer. And I don't think that ever will be the answer, regardless of how smart it gets. I think you've still got businesses are essentially people, system, and process. You still got at least a third of your elements is people. So I think it's important to address that, to be cognizant of that, and understand how they work together and how they deploy technology, and therefore deploy process, because it's those three elements that are critical, that need to come together. You can't have two without the third one. I don't think so. So that's kind of my guru technology position.
I think that's a good point as any to finish up, Sean. But I think you've been great. I've really enjoyed it. I think your approach to problem solving, storytelling, and innovation has been fantastic, and I think the listeners will agree.
Yeah, brilliant. Thank you.
So if there's any questions, anyone wants to reach out, ask you anything, are you okay for them to reach out?
Absolutely. Yeah, absolutely. I think I'm on LinkedIn. That's the only social media network I'm allowed on, because my wife tells me I'm not authorized to be on public platforms. People are not interested in what I have to say.
Fair enough. I'll chuck the links in when the show goes out, but thanks again for coming on.
Yeah, brilliant. Thanks, Tom. Really, really nice. Thanks, everyone, for listening.
Thanks for listening to the CFO Track. If you enjoyed the show, don't forget to like, subscribe, and share with a friend. I'll see you next time.